its first session of our webinar series on leveraging pension funds for housing finance in Africa. My name is David Shiabo, and I'm the coordinator of Making Finance Work for Africa, and we are very pleased to be hosting this webinar series on pensions and housing together with our partners from the Center for Affordable Housing Finance. I just muted myself there. So my name is Dave Dashab, and I'm the coordinator of the Making Finance Work for Africa Partnership. We are joined by 4 distinguished speakers today. First of all, we will have Dr. Alfred Shem Umar, who is Manager Research and Strategy from the Retirement Benefits Authority of Kenya, so the pension regulator for Kenya. We also hope to have Ms. Bopele Soko, who is the Director of Retirement Funds for the Non-Bank Financial Institutions Regulatory Authority of Botswana. We will have Mrs. Akosua Nelson Kofi, who is a portfolio manager of the Social Security and National Insurance Trust with Ghana's Tier 1 pension scheme. And hopefully we will be by Mr. Dave Udwano, who is the Managing Director, Sigma Pensions Nigeria, and also Chair of the Africa Pension Funds Network. Now, I know that Ms. Soko and Mr. Udwano are apparently not online yet, but we are hoping that they will be able to join us as we go, so fingers crossed for that. Before we get the main subject for today's discussion, just a few housekeeping items. First of all, the webinar is scheduled to last 1 hour. We'll try to keep it to that time because, we do recognize that having these conversations online can be a bit challenging at times. So we will try to keep to an hour. The commitment we make is that we will not go for an hour and 15 minutes. To ensure quality of experience for all participants will be muted from the control here at Making Finance. If you have a question, if you do have questions, and we do actually actively encourage you to submit questions, these can be done via the chat or the Q&A box. On the chat box, just scroll down and click on Making Finance MA Secretariat, type in your question and send, and it will come through to us here. And a recording of this presentation will be circulated to all registered participants after the session. And if you do have any issues, technical or otherwise, please use the chat box to let us, and there will be someone standing by there is someone standing by to support you as needed. Finally, a very important point, please do fill out the short survey that appears automatically after this session. The survey is important to us because it lets us know how we are doing and also gives guidance to other topics that you may want us to cover in future webinars. Finally, please feel free to publish, share, and exchange, and keep the conversations going on social media. We have Housing Pensions in Africa, and the Twitter handles for Making Finance are at MFW4A, and for the Center for Affordable Housing Finance are at CAHF _ Africa. So we look forward to continuing the conversation there. Now, just an overview of the subjects that we're going to be covering in today's session. First of all, I'm going to say a few words about the Making Finance Work for Africa partnership and our Center for Affordable Housing Finance in Africa. There is a slide also on our strategic partnership, what we are trying to do together. And excuse me. And we will get into the meat of the subject. We're going to discuss the drivers of pension fund growth in Africa. What is it that is leading to this all this interest over the last few years in pension funds in Africa, and what they're doing, and why factors behind that growth. Then there will be an overview of what the pension funds are investing and why. So look at some sample pension portfolios. We talk briefly about the housing market landscape. Then go into a discussion on long-term investment by African pension funds and what are the factors that are enabling or hindering that. And we will bring in our speakers. We have specific questions for our speakers, but at the end of the sessions, what we typically do on these webinars is we at least 20 minutes Q&A from our participants. So that is really where we will be asking the questions we've received from you throughout. Okay, so and then there's a last slide on the next webinars in this series. If you don't know us, the Makings Work for Africa partnership is like it says in the name, it's a partnership of development partners and the African financial sector who share a common vision of innovative, sustainable, competitive, and diverse African financial systems, providing near universal access by 2030 and offering a full range of products and services to support the real sector across Africa. We are the reference platform for advocacy, knowledge sharing, and financial sector development in Africa. We are currently hosted by the African Development Bank and funded by the African Development Bank, the German government through BMZ and GIZ, the European Investment Bank, the Agence Française de Développement. Sorry, we are missing the logo of the Agence Française de Développement on that in that box, so I do apologize for that. And the Dutch government through Minbuza. I'm gonna skip this slide because it's in the pack that you will get. But just to say that we do. Our objective in housing finance is really to support the development of the affordable housing finance market in Africa through the provision of adequate financing. And there you have some of the things that we do around this. So we do knowledge management and research, we do networking and advocacy, and we also do project support and capacity building. And in the middle of the slide there, you can see some of the partners with whom we work, particularly in terms of housing finance. Now, partners for this webinar series, the Center for Affordable Housing Finance in Africa, or CAHF. So CAHF is an independent think tank based in Johannesburg. They were established in May 2014, and their vision is an enabled housing finance system throughout Africa where governments, businesses, and practitioners work together to provide a wide range of housing options accessible to all. So very much a similar mission to main finance, except with a focus on housing finance. So the mission is to make housing finance markets work with special focus on finance for the poor. I seek to see an increase of investment in affordable housing and housing finance throughout Africa. CAHF is funded mainly by the financial sector deepening Africa, FSD Africa, who, for those of you who may know, is funded by the UK government through the Department for International Development, or DFID, and CAHF is also funded by the Agence Française de Développement. So that's what we have in common with them. So we do have a strategic partnership between Making Finance Work for Africa and CAHF. Basically, I had interest in deepening the understanding of housing finance markets in Africa. I'm just going to go straight to the activities. Joint working groups, we do case studies and knowledge briefs. And this webinar series is actually one of our joint activities with CAHF. To the core of the discussion today. So we're leveraging African pension funds to finance housing in Africa. And to set the background, we wanted to get a sense of what is happening with the pensions industry and why is it that there's all of a sudden all this interest in the African pensions industry and how they are investing. And it's fair to say that over the last, probably in the last 10 years or so, we've seen remarkable growth in pensions under management. So that's the AUM. When we say AUM, we mean assets under management by pension funds. And this is fueled by a number of factors which we've kind of grouped into the 4 boxes that you see. First of all, there's the demographic issue. Africa has a young and rapidly growing population, which fuels a steady increases in pension funds assets under management. And we do recognize that only between 5 and 10 of Africa's workforce is covered by formal pension schemes. But because Africa has such a young population, as more and more people enter the workforce, more contributions, so assets under management are increasing there. Secondly, Africa's macroeconomic growth story. Africa's state macroeconomic growth over the last few years, the prudent fiscal policies which have reduced bond spreads in some countries, and low interest rates in mainly outside Africa, which have also fueled, a search for new assets. Military environment, we've seen significant movement towards privatization of pension fund management across the continent. Ghana is a country that introduced them such reforms recently. We've also seen pre-retirement contributions introduced in several countries, which all this meaning that there are more people coming into the pensions net, as the private sector has also moved into the management of pension assets. We've seen significant growth as they focus solely on the search for yield, as opposed to development, as happens and in some cases where the pension funds are still managed by the state. In terms of investments, and when we say alternative investments in this context, we are talking about anything that is outside the listed. So anything that is outside paper, anything that is outside bonds, and anything that is outside and listed equities. Because it's under management, awareness and understanding of new asset classes for by African pension funds for access to unlisted or alternative opportunities, basically looking for access to sectors that are not very well or at all represented in the continent's listed markets. In terms of this, this graph it takes assets under management in Nigeria, and what we're trying to show here is the rate at which assets under management are growing across Africa. We've used Nigeria just as an example, but this growth is fairly typical of what is happening in most countries across the continent. Note is that we see that assets under management started at $7 billion in 2008. $7 billion US dollars in 2008, right to $30 billion in 2014, and then we are falling back slightly to $27 billion in 2015, a steep drop to 19 in 2016 and 20 last year. First point is that assets under management in Nigeria are growing at about 30% a year. We saw significant growth in dollar terms up to 2014, and then what happened in Nigeria is there was a devaluation. Well, not a devaluation, because their currency it floats basically, but the naira lost a lot of value between 2014. Actually, the main loss was between 2015 and 2016. So although it looks like a sharp drop in dollars, in naira terms, which is where the pension funds count and invest, it was still a significant increase. The reason why this is important is, from an investment point of view, the more money you're taking in, the more outlets you're looking for. So the second point to take from this slide is, because our pension assets are growing at such rates, there are opportunities. So I suppose we could frame it as a question. Does this create opportunities for pension funds to look beyond their traditional investments of government bonds and listed equities? This is a similar graph for Kenya, and there we see also in billions of dollars, and there we see assets under management growing from just over $2 billion in 2008 to $8 billion in 2015. It's a fourfold increase in just over a period of 7 years. So again, reinforcing the point about the growth in assets under management and the opportunities that this made for African pension funds to diversify their portfolios. What we is kind of where the pension funds are actually investing today. And again, we've used Nigeria simply as an example. What we found in our work is that this structure that we see here is fairly typical across Africa. And to focus on this is that big gray block in the middle. So you can see that from just about over 70% of UM is invested in Federal of Nigeria securities of some shape or form. And typically across Africa, we are seeing anywhere between 60 to 70%, and sometimes more. So in some countries, it's up to 80 of pension funds invested in government paper. Now, there's wrong with that per se, because pension funds want security of returns. There are other issues like interest rates, which mean that government paper, may be an attractive instrument for all sorts of reasons. But the question whether the investment in government paper is coming at the expense of other opportunities, which could A, be more profitable in terms of returns, or B, in terms of sort of funding the real sector of the economy. That's the picture from Nigeria. And again, these numbers are as at September 2017. And again, this is a picture that is repeated in several countries across the continent. Now, to say about the housing market, or the housing gap, or the housing deficit, I think that slide should have been called. Africa is projected to have the Africa region, is projected to have the highest population region in the world by 2030, I think it is. And pressures including increased urbanization, people moving from the rural areas to the cities, and other things, which means that there is a significant housing shortage already across the continent. In Nigeria, for example, the current housing shortage is estimated at 17 million units, and to fill that gap would require funding of $360 billion. In Ghana, the shortage is estimated at 1.7 million units, with funding requirements of about 52 billion. The Kenya, the shortage is estimated at 2 million units per annum. So the reason, part of the thinking behind this webinar series is knowing that we have these huge funding in terms of housing, and at the same time we have growing pension management, which are looking for outlets to invest. What can be done to bring these two sides together? So, of the housing market landscape, demand pressure, some of which we mentioned briefly before. Africa's population will have doubled by 2050. So, in about 30 years, Africa's population will have doubled. 50% of Africans will be living in towns and cities by 2030. So that's the demand for urban housing. We as Africa have the youngest population in the world, so we can expect the demand for housing grow because as young people grow and enter into the workforce, greater demand. However, on the financing side, we have very low mortgage penetration rates. So 3.2% in Kenya, it's even less, 1% in Ghana, and less than 1% in Nigeria. Partly because high interest rates, the macroeconomic story, high rates on government paper, perceived high credit risk, high transaction costs, and to some extent lack of in the banking sector. Other links to the growth of the housing market in Africa include developers and investors are focused on the top end of the market um, purely do not perceive the opportunity in the affordable end of the market. Poor targeting and insufficient scale. Few developers. There are very few developers that can deliver housing solutions on scale that we need to fill the gaps that we talked about before. And importantly, there are weaknesses all along the housing value chain, from supply and demand through to policy and regulatory um, and issues of the land titling, etc. The finance, due to high cost of capital, we've talked about before already. Lack of a diversified investor base, so lack of diversity in the of institutions and money that is coming into the housing market. Lack of investment at construction, capital financing for the developers themselves. So if somebody wants to develop an affordable housing estate or an affordable housing scheme, themselves have difficulty accessing the finance to do so. And then at the other end of the chain, the end users or the buyers of the houses also face difficult accessing capital. So also we believe an untapped opportunity in the affordable housing market for Africa. Sorry. Now to the pension funds, and a lot of work at Making Finance around pension funds and long-term investments in Africa. So we look at some of the issues what are issues that drive them that are driving them to invest long-term, and what are some of the issues that are maybe holding them back. And what summarized on this slide are some of the barriers that we've come across generally with respect to African funds and long-term investment. So what we're going to do is I'm going to talk through them rapidly, and then when we come to the question, when we come to the discussion points with our speakers, I'm sure they'll be picking up on some of these points. The first point that comes up a lot when we talk to Africa, when we talk about African pension funds and long-term investment, is the regulation. We often hear, oh, the regulation is adapted, the regulation doesn't allow African pension funds to invest in this kind of instrument, it doesn't allow them to invest in that sector. We looked at this very carefully across a number of sectors and a number of countries, and what we found is that, yes, in cases the regulation can be termed restrict, but in other cases the regulation provides opportunities that remain unexplored or unexploited. We have at least one regulator who will be speaking in a minute, so I'll leave it there for the moment. The regulation is not often as much a barrier as people to think it is. One of the high bond yields, I think that is really one of the critical issues, because in several countries across Africa, basically, the pension funds really have a choice. They get money in government paper, be they be they bonds or treasury bills, at often double-digit return. So that it becomes the benchmark for comparing other investments. The benchmark for that other investments have to meet, not in terms of return, but also in terms of risk profile. So That is a big barrier that I think we can unpack some more. We've spoken about, but we singled out this restriction on offshore investments. I'm not sure how applicable that is to the housing market, but it is something that we can explore on this and subsequent webinars. The knowledge, I think, is key because because of the growth that we've seen in pension assets and the reforms that have led to this growth started as early as 2008. So there is often a lack of familiarity with or even awareness of relevant markets and the instruments that it will take to invest in some of these new sectors and products. Data, this is something that we see across the board, whether it's about infrastructure, housing, private equity, absence of data as to market size, what is the actual size of the opportunity, benchmarking in terms of performance, because a lot of times these industries themselves in Africa are very young, so they don't have the track record for the pension funds to justify their investment. Pension funds often lack scale to build a credible alternative assets program. That is another important point. From the point of view of to build a credible alternative assets program, you need to diversify. And so you wouldn't, just like you would, buying stocks, you wouldn't put all your listed portfolio in one. For alternative investments, you want to spread it across a number of sectors, a number of instruments, whatever. But what we find is that a lot of African pension funds are too small to achieve diversification alone. But there are ways around it, and I think those are some of the issues that we will be picking up later in this series. Edges in terms of once I invest, how do I get my money back, and how do I actually turn a paper return into a real return, so that I can pay my pensions, as is my primary objective. And there's lack of product, and product I think is a big one, because there are few products out there across all sectors, not just in housing, that are actually designed with African pension funds in mind. They have different regulatory constraints or different regulatory regimes, different risk appetite. What is happening is that a lot of the times they are being approached with products that are not addressing their investment needs. So lack of product, I think, is an issue that we will come back to, if not in this discussion, then definitely in subsequent webinars. So I've spoken a lot. I hope I haven't been too long. I'm now going to bring in our distinguished speakers. And my first question goes to Dr. Umar from the Benefits Authority of Kenya, and really to understand what is are pension funds in Kenya allowed to invest in housing? What does the regulation say on that? If they're allowed to invest in housing, if so, how much? And regulator, what is your general view about investment in housing? So, Dr. Umar, please.
Thank you much, David. I've enjoyed your presentation a lot. And just to respond to the question, yes, pension funds in Kenya are allowed to invest in housing. And it is true that pension funds investments are regulated, and we have an investment schedule with the investment assets into which pension funds are allowed. To date, there are a total of 15 different asset classes into which pension funds are allowed. Investing in housing can fall into any of the categories I'm going to list now. They invest into housing through listed corporate bonds, mortgage bonds, up to 20% of their portfolio. Can also invest into movable property to 30% of their portfolio. And because of what you just mentioned, because most pension schemes in our jurisdiction lack scale and find that investment in property very huge investment that they may not be able to afford, recently we introduced a new asset class called real estate investment trusts that are incorporated in Kenya and are organized by the Capital Markets Regulator, the Capital Markets Authority, and into this they can invest up to 30 cents. Then, really, when we have now successfully gone through our prolonged electioneering period, now has a four-pronged agenda. It's called Agenda 4, and there are 4 key things that the government are now focusing on. And that includes investment in affordable housing, food security, ensure affordable care, and manufacturing. So, to enable pension funds invest in the provision of affordable housing, we propose to introduce another class category in the investment guidelines, and we call this debt instruments for financing of housing through public-private partnerships. And this debt instrument must be approved the Public-Private Partnership Act for Housing and Infrastructure. Pension schemes are allowed to invest up to 10% of their portfolios. That was introduced recently. It's yet to become law, so it is still being discussed. But that is an avenue of investing in housing. The challenge I have usually is what you also mentioned, that we have provided these upper limits on investing in housing. Them are invested in the high end housing market and not the low end, and that's where the government is now targeting. And we have had another development with one of the mandatory schemes, the National Social Security Fund, which has been exempted from observance of investment of property up to 50%, and they are allowed to be able to beyond that by a change in their act. It is established under the NSSF Act, and let us read what that says. That the Cabinet Secretary for National Treasury exempts the National Social Security Fund from compliance with the provisions under the regulations and of the Act, and has proposed that they can, through a prescribed financial institution, in affordable housing for members of the pension funds. And membership today is at around 3.6 million. And so that has also worked for us. But before, NSF has also been able to build houses for sale under the tenant purchase scheme. So those are avenues through which various pension schemes can exploit and invest housing, and that is what the regulator is. Let me stop for now. Thank you.
Thank you much, Dr. Uma. I'm now going to go to Dave Udwano, who is the Managing Director of Sigma Pensions and the Chair of the Ada Pension Funds Network from Nigeria. Dave, can you just very briefly tell us what the regulation is with respect to pension funds and housing in Nigeria? Thank you. Dave, did you hear me? Okay, I lost Dave there. Akosia, can you hear us? Oh, okay,
Yes.
Dave. Yes. Okay, sorry, Akosia, sorry, we've got Dave back. So, Dave, can you just talk us briefly through what the status is with respect to what the status of is? Sorry, with respect to pensions, investing in housing in Nigeria, please, just very, very briefly. Dave, we can't hear you. Akosia, can you hear us?
I can.
So I think Akosia, which what has been SNIT's experience in terms of investments in the affordable housing sector? And we've chosen SNIT because I know that you've had a lot of experience in investing in housing, in affordable housing particularly, in Ghana. So if you can just talk us through what are the main takeaways of that experience? What worked? What didn't? What you know now that you wish you had known then, etc. Okay.
Okay. Thank you, Dave. That the trust embarked on the construction of workers' housing units countrywide, and it was made as part of its social responsibility to meet the accommodation needs of its contributing workers. And it started as far back as the 1970s. Apart from those direct investments in affordable housing, we have invested in also some local private equity firms. Within our investment portfolio, key companies that are also investing in affordable housing. And we have a few subsidiaries, joint venture companies in which who also involved in the housing sector. What works? So the general objective is to get fair returns. There is some sort of social orientation. And the philosophy was that build these affordable houses, and then we would give them out to the companies in which the employers, and these employers would rent them out to their employees. Over the years, we realized that accumulation of rent, because this arrangement was not successful. So we had accumulated rent, and going forward, the trust decided that we will not do rental of houses, but we'll do outright sales of houses. And then we realized that even apart from the fact that we had sold these houses, SNIT was still bearing the maintenance costs of these buildings. We had a situation where the rents could not be increased as per the market trends, and had high maintenance costs for things. So we decided that we would try and sell these buildings, and the inmates were given a period of 5 years within which to pay. It is that you could either pay outright or could spread the payment over a period of 5 years. And this also did not succeed. So now the general rule is that we own houses for outright sales. Now, another lesson that we've realized is that we often go to build in new areas that are not developed. So SNIT, as part of the project cost, has to take up the infrastructure costs, that's the road, electricity, water, and this has an impact on the final cost of the houses when they are finished. And it becomes a bit difficult with these for the low-income earners to afford to purchase these houses when they come due. I think the last one that I would like to talk about is this issue of maintenance when the property is sold, where these at a point in time that they look like it's difficult to maintain because there's no painting, etc. One has tried to talk about the condominium concept where the tenants will build up associations and then we'll collect some CAM or some fees which they'll use to maintain these. We realize that collection of CAM in Ghana is not backed by law, and that is one issue that one has to look at. Finally, Dave, I would like to add that the mortgage market is not that developed, and so contributors have not been able to assess mortgages when they fall due. And even if they are available, the mortgage is not affordable by these low-income earners.
Thank you, Afia. Dave, can you hear me now? Let me just see if we can get you on the line now. Yes. Excellent. Okay, we can hear you. So can I ask you, because you to take a stab at the last question? The last question for the speakers. In terms of what opportunities and risks do you, as a pension fund manager, see in the affordable housing sector? So, and maybe the question behind that is, are you investing in the affordable housing sector? Is it something that you've looked at? What is it that would attract you to it, and what is it that scares you away? To have lost you. Okay, time. I think what we're going to do is we're going to move to the next part of the webinar. I'm conscious that we are running way over time, about 10 minutes of our scheduled time left, but you can do like football and go into extra time if we need to. So we will now go to Q&A. So, Mohammed, have we had any questions coming? We're just trying to go through the questions. Yeah. Question 2 is to making finance. I think this is an interesting one to discuss. It's from Olabode Ayemo from the NMRC in Nigeria. How can making finance work for Africa, as with driving down cost of funds for the housing business in Nigeria, having in mind the high risk-free rates? So I'm gonna take a stab at that, and I think I'm gonna open it up. I think it's important to understand what making finance is and what we can and cannot do. What we do is we facilitate, we do research advocacy, we share information, we do stuff like this to find solutions to address precisely the kind of list of questions. So we can help part of the objective of this webinar series and the whole work stream that we have around um, um, pensions and housing is precisely to look at, from an NMRC point of view, what are the risks? What are the key challenges? What are the risks? Why is it that those costs are high relative to the risk-free rate? There are out there that we can help develop. Some of our development partners here, I'm thinking particularly of people like AFD, EIB, that can sometimes actually share the risk they have a full suite of risk sharing products that can help, but that it is important that we note that those risk-free rates are an important part of the equation, and they are an important barrier not only for housing finance in particular, but for all other forms of long-term finance. Our work around that is, like I said, we support product development. We also do policy dialogue, which actually raises this issue brings this issue to the front of to the agenda as far as the governments are concerned, saying that, look, you have a housing deficit, but people can't afford houses because the interest rates are 20%, and you cannot grow at those rates. There's which I'm going to put to Dr. Umar if I can, and there's how long did it take Kenya to accept the need to use pensions to invest in housing? And that's the main question. Then there's two subsidiary questions, which is, was it gradually introduced, and did people struggle with the idea of allowing people to use their pensions, to invest in housing? So Dr. Umar, please.
Thank you very much, David. Investments in the different asset classes where pension funds are allowed to invest and therefore can put some money into housing has been there with us for some time now, and we constantly review that investment asset class to respond to market opportunities and the dictate of the market. The one particular one which I didn't mention, and we introduced a regulation that allows pension schemes to be able to actually use members' pension savings as security for accessing houses, mortgages. And we used that, I think, in the year 2011. So we allowed members of pension schemes to use up to 60% of their savings towards retirement as security. So we didn't allow the withdrawal of the monies out of the schemes, but they could be used as a form of security. And therefore, they would approach financial institutions and the banks for those mortgages and put that security. This did not work very well, and therefore what happened was that because providing direct access to the savings, when they would approach financial institutions for a house, the house becomes the first surety, the first security. And then banks would be able to provide the loans, the mortgages. What our development did not provide was to cover, for example, on the fees that are required for mortgages, upfront costs. These are the legal fees, the valuation fees, the stamp duties, which can also be colossal. And so we found that banks had
I think we lost you. Let me try see if Dave is if we can hear Dave now. Dave, can you hear us? Okay. Let me go through a number of questions that we have here. There's one from Norbert. Norbert, sorry if I'm not pronouncing your name correctly, from the Capital Markets Authority in Uganda, who's asking whether a study has been done on disposable income and how this fits into rental income growth. The answer to that is there's a CAHF study, so a study from our partners, the Center for Affordable Housing Finance in Africa, rental housing with case studies on Tanzania, Uganda, Cote d'Ivoire, Senegal, and Angola, which will be released pretty soon. We will give you contacts at the end of this so that we can send you a copy of that study when it becomes available. There's one question which I'm going to take. Could you speak a bit more about the number and size of private versus public pension funds in Africa? I think it's difficult to answer that question at a continental level because the countries differ and it's a question of relation. What you do have in each country is that, in most countries, is that you either have one massive public pension fund, like an NSSF. So in Ghana, that would be SNIT. In Ghana, historically, SNIT was the only pension fund, and then you had company schemes on top of that. And of course, those company schemes are difficult to virtually unregulated, as a matter of fact. Unregulated, as a matter of fact, and those company schemes, because they are unregulated, it's difficult to know how many they are. But what you have in each market is there is one big scheme, public or private, which would control where from 40 to, in some cases, 80% of the AUM, and then you have a number of smaller schemes. So in the same way as when you're looking at AUM across the continent, you have South Africa, which is like 90%, and the rest of the countries. Get that repeated across. So it's difficult. And if you take a country like Nigeria, for example, Nigeria, there is no public pension fund. What they have is individual pension schemes which are managed by pension fund managers. So that's the answer to that. Another question. Sorry, let's find it. How regulatory frameworks within regional bodies for regional investment of pension funds in neighboring houses, in neighboring housing sector. Sorry. Again, most African pension funds are not allowed to invest outside their jurisdiction. In some of the regulations, you will find that to invest outside, they're just not possible, or requires an exemption from or in some cases even the president. Exceptions are in regions where we've seen a lot of formal integration. So in East Africa, I know that some investments within EAC, and Dr. Uma will correct me, I know that some investments within the EAC are treated as domestic investments. I'm not sure whether that applies to housing. But one of the things that we at Making Finance is trying to do is a network of pension regulators, so that they have these conversations, standardizing regulation. How do we open it up? Because this applies not just to housing, but also to infrastructure. Okay, we have one last question. I'm very conscious of time. We're going to take one last question, and what we will do for the rest of the questions is we will share them amongst the panelists, and we will try to give you written answers in the next few days. And this is from Deborah Erb, who I think is from. Sorry, I know you're from, Deborah. I'm seeing where you're from, Deborah, so apologies for that. Since it has been difficult for pension funds to invest directly in housing, it's fair to say that pension fund regulators would actively support the creation of instruments to allow indirect investments. And I think, Dr. Umar, I'll come back to you as our resident regulator on the panel to take that. Dr. Umar, did you have that question?
No, I didn't. I've not been hearing anybody. I don't know what happened.
Okay, I think we lost you. Must have been the internet connection. So the question is.
Yes.
So the question is, since it has been difficult for pension funds to invest directly in housing, is fair to say that regulators would actively support the creation of instruments to allow indirect investments in housing?
I think we support that initiative very much through introduction of investments, and I just cited when I was talking about the regulations that even now we are introducing another new asset class to allow pension funds to invest in housing in affordable housing through a debt instrument. So that is and that we support us.
Thank you very much, Dr. Umar. Dave, I don't know if we can hear you now. Dave. No, sorry. We are not hearing you. Okay. So we are slightly over time. What I'm going to over time. So can we, Mohammed, can we have a slide, please?
Hello.
Dave, we can hear you now. Hello, Dave? We're gonna have to leave it there. So thank you everyone for joining this webinar. It's been a very interesting discussion. Like I said, we'll circulate the recording of the webinar and the slide deck in the next day or two. We will also try to answer all the questions that we couldn't get to in writing, also within the same period. And a reminder that this is the first in a 3-part webinar series. The next webinar, which is on opportunities and challenges in the affordable housing sector, is scheduled for March 29th. The third and final, which will provide market insight and industry knowledge on the affordable housing market and opportunities for pension funds in this market. That webinar will really bring both sides together to opportunities to leverage pension assets for affordable housing. There, we'll be dealing with more, the question from issues like the question raised by our friend from NMRC in greater detail. That one is scheduled for April 19th. Of course, participated in this webinar, you will automatically receive options to those two webinars. So please do register for those. We look forward to speaking to you then. In the meantime, thank you very much for joining us today. They have now on the screen the contacts both from Main Finance Work for Africa, for Housing Finance Work Stream, and for our Pension Fund Work Stream, and also the contacts for our colleagues from the Center for Affordable Housing Finance for Africa. If you do need any further information on the issue that we've covered on this webinar or any other subject of interest, please do feel free to shoot any of us an email. Finally, please can we just crave your indulgence and ask for 2 more minutes of your time to fill in a survey that will appear automatically on your screens when you exit this webinar. So thank you very much for joining us today. A special thank you to our speakers, Chris Nelson Kofi from Ghana Social Security National Investment Trust, Dr. Shem Umar from the Retirement Benefits Authority of Kenya, and Mr. Dave Udwano from Sigma Pensions in Nigeria, and apologies for any technology hiccups along the way. Thank you very much, and we look forward to speaking to you again soon.